Hi, everyone. Welcome back for Your Money Matters. I am Angela Giroux, publisher of the Bauman Letter. And joining me are Ted Bauman, our editor, and Clint Lee, our research analyst. Now, here at the Bauman Letter, we are focused on helping you obtain financial freedom. If you'd like more information on that, there is a link below. But we'll say that given current market conditions, obtaining that financial freedom may be more difficult than ever. So Ted, do you want to walk us through some of those conditions that we're facing right now pretty quickly?
Sure. In my video on Friday, I talked about how the Fed is basically out of ammunition. There are some tools it still has in its toolkit it hasn't used, but it's not going to use them, I believe, because they cannot address the current problem, which is a lack of aggregate demand in the economy. So I think the market knows that. So basically the Fed has shot its bolt. It's what the Fed is going to do. It's done. And everybody knows that for the next 3 years. You can't look to the Fed to rescue. We have big volatility coming from the election. All the headlines are saying it's going to be volatile. The futures of volatility futures for December are way higher than those for November. That means people expect that there's going to be big problems in November in the stock market. We're expecting big rotations. We see there are a lot of institutional buyers who are holders of stocks like big sovereign wealth funds like Norway, et cetera. They're going to have to rebalance soon, and that means they have to unload stocks that have risen so much in value that they are too big in their portfolio. So that's all means that we're likely to see issues. So what that means to me is that the era of, stocks only go up, speculate, you're likely to win, throw a dart at the wall, you'll make money. I think that's over this year. And so what we need to do now is look at what the alternatives are. And here I have an interesting chart that came up yesterday on one of the newsletters that I think we all follow. And it shows what they call the hierarchy of financial needs. A lot of people have heard of Maslow's hierarchy of needs, shelter, et cetera. But this one is interesting because it basically, I think if most people can look at this, anybody watching it and see, well, where am I right now? Am I at the cash flow and basic needs position? Am I trying to achieve financial safety? Am I accumulating wealth? Am I financially free? And I think the reality is that a lot of people are probably below the financial freedom level. And the question is, how do you get there? I mean, what are the strategies that are actually going to do that, especially in a situation now where the opportunity to make these incredible gains from speculation in the market, which I admit has done really well, is probably over. So the question is, how are you going to do it? And that's really what interests me today.
All right, Clint, what are you saying? Because obviously we're seeing, people were investing in bankrupt companies and they were making a fortune. It seems tech companies now are reaching something of a top. So where do we go from here?
Yeah, well, I think there's something interesting in the chart that Ted was just showing, and it's the stat that only 29% of Americans over 50 feel prepared for retirement. So reaching sort of that financial freedom phase. And I think the reason why that number is so low is because a lot of times investors can kind of be their own worst enemy, because you're acting on sort of that cycle of emotion, that greed and fear, which leads you to a lot of times you make the wrong decision at the wrong time. And there's a chart to help illustrate kind of the impact that can have on the returns you realize. So this is a chart I'm going to put up here real quick. This is from JP Morgan, but they put together results from this study called a Dalbar study. And it shows you asset class returns over the last 20 years. Now, this is through 2018, but since it's 20-year annualized, including 2019 is not going to change us too much. But look all the way on the right. When you look all the way on the right, you see the average investor is the worst performing thing on here, up only 1.9%. Versus look toward the middle of the chart, you see the S&P 500 up 5.6. So that would just be kind of a buy and hold the S&P 500. A 60-40 portfolio, 60% stocks, 40% bonds. It's kind of a common allocation for someone as they're approaching retirement, up about 5.2%. So that's what I mean by investors kind of being their own worst enemies, doing the wrong thing at the wrong time. And even now, highlighting the what we're seeing in the markets, not potential, we are in bubble territory, and it's just a matter of when's the bubble going to burst. And just this week, I'll show you a chart right here of what the NASDAQ's done just recently. I mean, we've had this incredible run this year, but then we peaked around this 12,000 level, and now, all of a sudden, just in the last couple of weeks, we've pulled back by 8 or 9%. So the gains that we've had up to this point can be quickly erased. Now, there's just one other thing I want to show in this chart, because everyone's just becoming so obsessed with tech stocks and the big gains that they're seeing there. But going back to this Dow bar study one more time and looking at these range of returns, look all the way on the left, you see what REITs have done. The best performing thing over this 20-year time frame is REITs, up almost 10%, almost double what the S&P 500 has done. And I think this is a fair representation, because being a 20-year study, you've seen all types of markets. I mean, over the last decade, we've become accustomed to just having a bull market. Well, I don't know when, but yeah, we're going to have another bear market at some point. And this captures how these asset classes have performed throughout the ups and downs.
All right, Ted, so let's go back to this idea of financial freedom, because we just looked at a couple of charts that make a couple of things very obvious. When we're talking about financial freedom, we're not talking about picking a winning stock. We're not talking about speculation. So, and again, considering all that's going on right now, how do we go about really obtaining that financial freedom?
Well, ultimately, remember, I mean, I've always said in the past that you're not making money when you speculate on stocks. You are creating the possibility of making money if you cash out at the right time. Because remember, the value of a stock is just a number until you actually convert it into cash. If you want to make money, if you want to have financial freedom, you need to take income from stocks. In other words, you need to get paid by the companies that are actually, that you've invested in. I want to show a chart that shows the power of taking income from stocks as opposed to just speculating. And this chart shows the relationship between the S&P 500 level on its own since about 1990, and then the S&P 500 if you had reinvested dividends on companies. And remember, the average dividend really is only around less than 2% for the S&P as a whole. So that is a remarkable record, which it's basically doubled. I want to show you two more charts that illustrate hypothetical examples. The first one shows what happens if a company pays a 5% dividend over 30 years. You invest $1,000 in it, you reinvest that 5% dividend into new stock every year. Let's assume that the stock price stays the same, which is also unrealistic. But in 30 years, you got 15 times more than you put in. If you buy the same stock and then have it increase its dividend by 5% a year, which is not unrealistic for a lot of companies, you end up with over $200,000. And that is from the perspective of just reinvesting dividends. Now, admittedly, 5% is probably on the high side for most companies. It's not unusual for REITs, however, and particularly if you buy REITs at a low point. If you buy them at a time when they are cheap, which is the case for a lot of REITs right now, you can do very well. Last chart I want to show you is just, again, just the relative performance. If you look from 2000, the bottom line, the red line shows S&P 500, top line shows Dow Jones REIT Index. And again, it's just, I mean, there's no comparison. So the way to get financial freedom is to go for income and then reinvest that income until you're ready to retire. Then you turn that income into the money that you're going to use, both through liquidating stock holdings and through taking dividend payments. I mean, that the facts show it. That is how it works.
So speaking of REITs, since they do offer such great dividends, but of course not all REITs are created equal. Some are outperforming. Which REITs, Clint, I'm going to ask you, which sort of REITs would you be looking at right now?
Well, going back to Ted's point, I mean, he's highlighting the power of growing your yield on cost. So basically the time that you get into a dividend paying stock, such as a REIT, and then having that underlying company being able to grow its dividends over time boosts your yield on cost. So when I think about that, I want to look at the faster growing segments of the REIT industry. Where are we seeing the best opportunity, the best potential to see our dividends grow over time? And right now, I mean, we're seeing incredible demand for data center REITs, especially with the work at home, stay at home economy. Data center REITs have been performing very well. Logistics REITs as well, and warehousing REITs, because of the surge in e-commerce volumes. This isn't a one-time thing that is here and is going to go away. I mean, we've seen e-commerce as a percent of retail growing over the years, and this has accelerated that trend. And so we've seen companies operating in that space and in the logistics REIT space performing well here too. And then, everyone's talking about the 5G cycle. Well, for the 5G cycle to get here, you actually need to deploy the infrastructure. And there are REITs that operate within that cell tower space that stand to benefit from the infrastructure build out as it pertains to 5G.
Yeah, and it's worth noting we do have some data center and logistics REITs in our Bauman letter portfolio that are really crushing the market right now. Isn't that right, Ted?
Right, yeah, and I think Clint's absolutely right. And I think here's the thing, and a mistake a lot of people make is they look at these REITs in those growth sectors, in other words, where the REITs themselves, their stock prices are going up, they think, oh, well, the yields are low. The thing is, remember, REITs are required by law to distribute 90% of their taxable income as dividends. So when you invest in a REIT, let's say maybe has a dividend yield of 1.5, 2.5%, the goal is not to, don't look at that and say, oh, poo-poo, I'm not going to do that. Because that dividend is going to grow. You buy it now, in 10 years' time, your yield on cost is going to be high. The other approach, one that I've also recommended very strongly in this environment, is to look for undervalued companies that have maintained dividends and grab them in order to basically get a very high yield on cost from the get-go. There are companies in what look like vulnerable sectors. We have invested in one in the Bauman letter, where the price is down because there's guilt by association. It's in a retail sector. It owns retail type stores, but they're the kind of stores that you can't live without. So we buy it at a low point, and we get a much bigger yield. You can double your yield if the price of the stock falls, right? And so essentially that's the other option. Now, there are some companies out there that I think provide that kind of value in the retail space, particularly in the types of retail environments that are not going away. There are some that are going to go away. We know that, but there are some that aren't. And if you look in the right REITs, you can get them. Residential apartment REITs are big. Retired community REITs are big. I think there are plenty of value opportunities out there. So if you want to make those charts work for you, the ones that we've just showed you, and get financial freedom, that's where to look.
And on that note, we have a new report coming out this week about Ted's #1 income investment, and the yields here really trounce anything you're going to find in the S&P 500, the average. So I invite everyone to make sure today that you sign up for Bauman Daily. You don't need to sign up for the Bauman letter to see this one. You need to sign up for Bauman Daily to get this full report later on in the week. The link is below. Make sure you check it out. Ted, Clint, thank you so much.